This video is about depreciation accounting, and as part of the depreciation accounting series, we'll be sharing videos on the basics of depreciation, which is the current video, methods of depreciation in the separate video, revaluation of assets, and lastly, amortization of intangible assets. So let's start with basics of depreciation accounting. What is depreciation? Depreciation is nothing but decrease in the book value of any tangible asset. Now there are two or three key terms involved here. First is decrease or decline. So any decline or decrease in the value of a tangible asset will be termed as depreciation. Now again, there are two more terms involved: tangible and asset. So tangible, anything that you can see, feel and touch. Asset means anything which gives you economic benefit in long term, in future. Now the basic fundamental because of which there can be decline in the value of asset is because it is used time to time. There is a physical wear and tear. There it can be due to passage of time, and also it can become obsolete. Now, why do we exactly charge depreciation? There's a very specific reason to it. It's because accrual basis of accounting. So, accrual basis of accounting says revenue has to be recorded as and when it is earned, and expenses should be recorded as and when it is incurred. So, let's say you buy an asset for $10,000 and you use that $10,000 value asset for 10 years. So, after 10 days, let's say you have to decommission it. So, you cannot just write off your asset after 10 years straight away from your books. You have to accommodate the value of that asset into those 10 years based on your depreciation method that you choose, and then accordingly depreciate it and charge it to your profit and loss account, so that your P&L does not get hit directly at the end of the 10th year. What is residual value? Residual value is nothing but scrap value or the breakup value or the salvage value, whatever you want to call it. It is basically whatever you recover at the time of decommissioning the asset. So whatever is the market value, once it is no longer to your business, that's called residual value. Next topic here is methods of depreciation. So there can be various methods of depreciation. The most commonly used one is straight line method. Straight away you have to divide the recovery value of the asset amongst the number of years in which you are supposed to use the asset. Reducing balance with the diminishing value or the written down value method. Here you have to charge depreciation at a certain rate, and that will be charged on the net book value of the asset. For example, the asset value is $1,000. So for the first year, rate of depreciation is 10%. You charge 10% of the first year, and then after the next year, the net book value will be 900. So you have to charge 10% on the net book value, which is 900, and accordingly follow the same process till the time the asset is there and you have significant value in the books market in the book value of that asset. Units of production method, machine hour method, sum of years of digit method, and there is one more method which is called depreciation method. There can be more number of methods, but we'll be discussing only these methods in a separate video. I will tag that in a playlist, or let's say in the description box of this video when I am able to record it. Next part here is the journal entry, the most important one. Whenever you buy an asset, you have to debit that, and then it can be bought against your creditor's account, or you can just pay it simply from your bank account. So the entry will be tangible asset account debit to bank account or creditor account. But the main part here is how to charge the depreciation. So depreciation being your expense, it will hit your P&L. So depreciation, whenever there is an increase in it, it will be debited because it's an expense. Now where do you credit the depreciation expense? According to the most commonly used GAAP standards across the world, it is always credited against a provision, against some accumulated provisions. Here we are calling it as accumulated depreciation account. So you depreciate the value of the asset and store the value in one single provision account, here accumulate depreciation account, and then at the end of the life of the asset you use this accumulated depreciation to adjust and credit your assets value. So here the last entry will be your sale entry along with the adjustment for accumulated depreciation. So when you sell the asset, you have to debit whatever money you get, so bank account debit, then adjust your accumulated depreciation. So it was always getting credit because it was a provision for you, it was a liability for you. Now you are debiting it, so accumulated depreciation account debit. Let's say you are selling the asset at loss, so loss on sale will be debit, and then tangible account gets credited because you are crediting, or let's say you are removing your assets from your books. And finally, let's say if there is a profit on sale instead of loss, then again profit being your income will be credited because there is an increase in income. We will take some practical example. So let's say you have a asset which is a machine, and the cost of that asset is $1,000, scrap value is 200, useful life is 8 years. The depreciation method is straight line. Since it's a straight line and the value of the asset is 1000, out of which there is a scrap value of 200, so the net book value here is 800, for which the useful life is 8 years. Straight line method, so that means you have to divide the value of asset across the number of years. So 800 divided by 8, it will be 100. So you have to charge depreciation 100 across 8 years. But this machine gets sold for 400 at the end of 7th year. So let's see what will be the final figure at the time of selling it off. So you have 1000 as the cost of the asset, and then residual value is 200. So book value is 800. Life is 8 years, so you depreciate it for the first 7 years, and at the end of 8th year you sell it. So there is no depreciation of 8th year. Now how do we pass the journal entries for it? So the first time when you buy the asset, you have to debit the machine account in your books and then credit it because it's we assume that it is bought for cash, and then the depreciation entry start. Depreciation entry will again be very simple. The depreciation being your expense will be debited against your accumulated depreciation, which is the provision for you. So increase in provision will be credited, and the same entry will be repeated from the first year till the 7th year. And finally, at the end of the 7th year, you are selling it out for 400. So you are debiting your bank account 400, and then you have to adjust your accumulated depreciation. So whatever balance is there in accumulated depreciation, which is 700, you have to debit it. Finally, credit your machine account. Machine's book value was 1000, and then if you check the balancing figure here, 100 is the profit for it. I hope the concept was clear, and if you have any queries, do let me know in the comment box and I'll be happy to help you. Thank you.